Welcome to the Xceptional Insights podcast. I'm Sean Wargo, and I'm joined by my colleague, Peter Hansen.
Hello.
Together, we make up the market intelligence team here at Avixa,
Where it's our job to identify trends in the economy and understand how they affect our industry, the professional audiovisual industry.
Welcome back to another episode of Xceptional Insights. I'm Sean Wargo, and this is Peter Hansen from Avixa. We're here to do a little bit of a reality check now and talk about 23 and 24 growth rates. As we've kind of talked about and forecast for IOTA, we saw great growth coming out of the pandemic after just a terrible period of decline. 21 strong, 22 strong. Each time we saw growth kind of pulled forward in our forecast estimates. So at this point, we're looking at declining growth of about 5 points, 12.5 to about 7.5% from 22 to 23. What we want to explore a little bit today from a macroeconomic perspective and from just a market perspective is, where are we? How did 23 end up as we're putting together our State of the Industry report for the end of 23? How did we end up? What are we looking like? What are the primary drivers of both growth and potential downside risks for us? So Peter, kick us off with kind of where we are macroeconomically as we look at, in hindsight, kind of what happened with 23.
I would say that we entered 2023 with a bit of cautious optimism. Now, you mentioned 2021 was this big growth year off the back of the terrible 2020. That big growth was really driven by macroeconomic recovery, a great just percent GDP growth, not so much return to in-person, some return to in-person that helped Pro AV. And then 2022, actually macroeconomically, kind of a mediocre year, but a great year, the record year for Pro AV growth. You see it in the Pro AV Business Index, see it in the IOTA numbers. That was really that return to in-person, kind of getting back to the stuff that drives not all of, but probably most of Pro AV revenue. So when we entered 2023, we knew that return to in-person wave that brought revenue back up and beyond the 2019 pre-pandemic high was mostly over. We're not sure. Like, it was going to continue affecting our industry, especially in live events area, like we talked about last episode. But that it just wasn't going to be the same tailwind, and so growth was going to be lower. Like you said, about 5, maybe a little over percent lower, 5 percentage points. So that's like 12.5 versus like 7, low 7s, mid 7s, and that's that. We'll start with that one trend. Return to in-person definitely been lower as expected, and I would say potentially maybe even a bit lower than we thought. That overall tie that made 2022 such a frenzy definitely blew itself out to a high extent in 2022. Not everywhere. Again, experience definitely still driving revenue, definitely a big positive part in 2023 and driven by the return to in-person. But overall, less so. And you maybe heard that little symbol I said, the frenzy in 2022. Relatedly, supply chains, huge issues last year, and that's a factor that has been one of top several defining impactors for our industry in 2023. What are we seeing so far, Sean?
Yeah, the supply chain is an interesting one. I think we talked about supply chain. We really have to rewind the tape a little bit, right? Back in 2020, the pandemic hit and a recession corresponded with that. We also had pullback in activity. And so you can imagine that in normal times, without a pandemic, recessions tend to be a little bit longer, right? And so the market, we think, really responded to that decline in demand, thinking, we're in for a longer ride. Auto manufacturing perhaps is an example of this. But you could see a situation where the demand was rapidly declining, other than in some core areas of AV, like corporate and education, which were investing in adaptive technology to basically keep business going, keep classrooms operating even if virtual, keep workers productive even if virtual. So those types of technologies made sense. But we sort of thought and knew the experiential part would decline rapidly. Mm-hmm. So you could see where manufacturers responded to that pullback in capability, some of it very real, just impacts of pandemic. You couldn't manufacture, you couldn't ship because your whole infrastructure was impacted by people out sick. and needing to close factories. But that has, at a certain point, there's a recovery. And as you said, as you talked about for 21 and really into 22, demand rebounded very rapidly. It started in 21, reached a crescendo in early 22, so much so that we were just not in a state as a market, as manufacturers, to be able to realize, to fulfill the demand that was coming through. So I think it makes sense now, especially hindsight's always a great way to look at things because we have a sharper vision now than we did at the point in time. But we can see where we're naturally getting through, recovering from and addressing those supply chain issues to where, yes, things look a little bit better. We're seeing it in our data, 2023, a lot of the major issues have improved. I would also note that, as we've talked about on other podcasts, we saw distribution come in to help solve some of the problem. That's also a natural and effective response of a marketplace where distributors can help a company, an end user, an integrator who's looking to get supply for their projects. They can help them work through those challenges, substitutions, alternate solution areas, alternate products, a whole bunch of different ways, and also just buyer power, being able to get access to what inventory is available. So clearly that helped us in 23. But we knew as we came out of 22 even that we were looking at an overhang of demand and that we'd work through that. And that overhang may have meant that some new demand was not really able to come in yet because we're still trying to just solve for what was already there.
Yeah.
I guess the question is there's been this perpetual talk of, well, it's coming, right? The recession of the pandemic, short, very brief, fortunately, limited impact, rapid recovery. But there's been the concern all along of the kind of carryover. Would there be another recession brought about by inflation and or high interest rates? Talk about those sort of things. Those two perhaps contributors as we look at 23 and maybe even to 24. How are we looking in that regard? Is interest rates look like they're here to stay for quite a while, and so that kind of creates potential headwind, right, for future.
First talked about return to in-person in 2023 being maybe a little disappointing relative to initial expectations. We were in the right ballpark. I feel good about, but I think maybe on that aspect, it's been less positive for Pro AV. The macroeconomy, when we were starting 2023, Avixa was like a little bit more positive on the macroeconomy. I think the kind of overall economic sphere was, you could see a lot of forecasts saying 90% chance we're going to have a recession when you're talking about this time last year. And we were staying all right, 50%, maybe it's over 50%, but guys, let's be a little bit more calm here. As well, one key point that we made is whether it ultimately is a recession versus not a recession, we're looking at this year where the cone of probability centers on the macroeconomy is not going to be too much of a negative. If there is a recession, it's going to be relatively mild as we just deal with high interest rates, trying to sort out the inflation issues in the economy. Or we're going to have growth, we're going to dodge it, but it's not going to be some bullish, 2021 style, the macroeconomy was hugely growing and therefore we were able to achieve really good Pro AV growth. So I think that prediction worked really well. And I think the good news is that the macroeconomy has been stronger. Actually, third quarter U.S. GDP was crazy high. 4.9% was one macroeconomic commentator said something you could knock me over with a feather. It was that how shocking that number was. That's a bit of an outlier from the overall global economic story of it's not great for GDP. We track the IMF numbers and probably more downward revisions in terms of 2023 growth numbers between this early in the year and between April and October when they do their 6 month projections. But at the same time, there was a lot of positivity. We're not we just had a year pretty much where for the U.S. banked no recession. UK was a country that looked really likely to have a recession, and they're having a mediocre growth year, which beats the heck out of a recession. One country where it is negative is Germany. They have hit a recession. So it's this mediocre macroeconomy, I would
Mm-hmm.
say overall,
Mm-hmm.
on average, but it's been better than feared. So I think that's been a little bit of a boon for economic growth. Now, you mentioned another trend, which is a longer term one, which is high interest rates. So the sort of overall narrative on high interest rates, or sort of the overall perception, let's say, is that they were going to be temporary. Now, what data tells us that that was the belief? If you look at like longer term maturity, 10-year T-bonds, 30-year mortgage rates, right? Or 30-year, especially like treasury rates more than mortgage rates, they were like disconnected a little bit from the interest rates that the Fed created. Like if you're like 5.5% at the U.S. Federal Reserve Board, what is the 10-year T-bond rate you expect if that's what we're at? It was a lot. The expectation based on that interest rate would be a lot higher than what it was for a while. But probably in the last maybe 3 months, we've started to see those bond kind of rates increase. And it's been, I think, a bit of a paradigm shift from these, let's call them moderate interest rates, because they're not really high historically, especially if you go
Right.
back to, folks know the 80s interest rates. Like my parents who bought a home in the 80s, like, whew, those numbers, different. like, so let's say we return to a moderate interest rate. Initially, that was supposed to be temporary. It was supposed to be this like blip, get inflation under control, and then we see the reversion to 2010s normal of like very rock bottom interest rates, really low like mortgage rates, rates for businesses making investment. And now in the last few months, that's changed. And I think that's going to matter a fair bit, not in terms of like top 3 trends for the next year or 5 years, but just on the margin, like as we talk about things we've talked about previously about, trying to turn from CapEx to OpEx to avoid, upfront, turning, upfront service costs into managed services, again, to avoid those upfront sticker debt finance purchases. With these longer term, higher interest rates that folks are kind of starting to believe in now, it just gives more legs to those trends. One other one was that we had talked about was movement to cloud, right? Instead of upfront purchase of the hardware, on-site installation, operating expenditures via cloud solutions.
Right.
So that's just, these little trends that we've seen throughout 2023 that are in line with what we were predicting, but like, pulse check. That's one of those ones, interest rates, where it's like, yeah, we knew interest rates were going to be higher, and now it's looking like higher for longer. Maybe not like peak level hasn't really increased relative to expectations at the start of the year, but where they are in 3 years, 5 years, 10 years, that has kind of gone up. And so something I think important to keep in mind, not as like a restructure your business, but as like, just kind of keep that in mind as you're like balancing decisions where you're kind of like 50-50, 55-45, 60-40, maybe like, this should push you one way.
I would think that for our marketplace, the question they're wondering about is all of that. Does that mean that our customers are going to be spending less because they don't have the means to finance, the interest rates are too high for them? I would throw out another data point on that, though, that we use a lot in our presentations is in that context, we are though seeing high corporate profits, right? So there is holding on to revenue, funds, monies, basically, in the thought that I think we're at this inflection point where we knew this would sort of come, where, as you talked about, the return to in-person sort of plays itself out, and audiences are coming back, workers have come back by and large, at least 3 days a week on average for companies. They figured out sort of how much they want to do distance learning for higher ed. They figured out how to kit their classrooms and spaces to be able to facilitate mixed mode, whatever that might be. And so we knew there was going to be this inflection point where that sort of stuff plays out, and then companies are waiting to make sure that the audiences for live events and entertainment and travel and hotels, staying at hotels, hospitality, all that sort of stuff, purchasing through retail, I think the marketplace was sort of waiting and watching and saying, yes, the customer's coming back. They've held on to some profits, thinking that, well, we just want to make sure that things aren't just going to fall back down, that the consumer would retrench. So I hear a lot of that narrative too in economic circles of, are we reaching the end of even consumer savings? And so the consumer's going to pull back. I would imagine some of the customers that we all serve are sort of wondering that too, and maybe holding on a little bit. Is that kind of where we are? Where I think we've talked about this for live events too, of making sure that you've built back revenue, that you've cleared some debts before you start investing in kit and in technology.
Yeah.
So I think that's part of what's happening too. So the slowdown in growth we knew would come. But what we may not have seen as we think about 2023 is the depth or the kind of length of the inflection point to where 23 could end up actually underperforming, which may give you optimism then for future years, 24, 25. But I'd be curious on your thought of that. Is that sort of what's happening too?
Yeah. So 2023 growth has really been underpinned, as you've mentioned, by strength of the consumer dollar. And I think that's maybe part of why, the macro economy's been pretty good. But I think maybe pro AV, when I talk to folks and we collect our monthly data and I read what these companies are saying about the environment of demand, they're probably a little more negative than what you'd think based on GDP. And I think that's probably because the strength is a little bit more consumer side than this B2B side that we're in. But we mentioned that 4.9% number for the third quarter, and that was pretty well split between there's strong consumer growth, but there's also strong business investment growth. So if you're looking at these high interest rates and you're wondering, man, does that mean that companies aren't going to want to spend anymore? Are they going to be really scared? One, yes, it does matter. What you can afford at a given revenue when interest rates are high is less than what you can afford when interest rates are low. The kind of threshold for that's a worthwhile investment, that's not a worthwhile investment is different. When the debt financing costs are higher. This is why the Federal Reserve raises interest rates to slow down the economy, because it reduces business investment. But it's by degrees. It's really there are a lot of opportunities out there that are very worthwhile, and businesses are not going to blanch at 7% interest rates as opposed to 4%, because they're expecting 15, 20% returns, because they know they have a good product. They know that it just needs this marketing or it needs this capital expenditure to realize their plans. And I'll just say one more good little point, as we talk about where we are now and how that translates into the future. The economy's healthier if interest rates are higher, in the sense that, a 2001 style recession where it's not we're getting 2 consecutive quarters of bad growth, but it was this quarter's contraction, next quarter is 0.2% growth, the next quarter is 0.1% contraction, just weak economy, uncertain. Having interest rates at 5.5% means that the Fed has this pretty strong lever to pull to say, hey, time to spend. And all of a sudden, there's a bit of more money flowing in the market, and companies are able to make more investments, and consumers are able to spend more and then juice businesses. So I think it's maybe, you could see this as a negative, at the margins, not a huge effect, but yes, it's going to decrease business investment, but it also creates this little bit of, I think, potential that's good to have in the system for if and when a recession does happen, to give the Federal Reserve more immediate power to get spending going again, to keep the economy healthy, which will absolutely, in that case, benefit Pro AV.
Yeah, I also think there's probably, to kind of bring it to our market even further, and what assumptions were going into 23, and even as we came out of 22 into 23 and kind of looked at, and actually even reflecting back on what propped us up through the pandemic, I think that there was also this assumption throughout our marketplace that this mode of supporting hybrid, whether it's for corporate or for higher ed, some of bellwether parts of our market, even into government, that there was this expectation that that's sort of going to carry it. We actually, those markets, those parts of our industry actually did grow as other parts were contracting. So I imagine that there was, as I look at the symptoms that we now are seeing of areas of weakness in 23, which we'll talk about next. As we look at that, a lot of that is this assumption that corporate, conference and collaboration, higher ed learning solutions, that those are just going to continue to do well because companies are going to continue to invest in those areas as they go through perpetual beta experimentation, recurring investment to improve upon what they built. I think what we've seen is that there was a lot of supply that came into the market to support that, whether it's Bluetooth cameras, Bluetooth speaker sets for conference rooms. I think that a lot of companies now, as we look at this work from home, work from office dynamic in the hybrid model, a lot of companies are they're not waiting and seeing, but they're sort of taking stock and figuring out how to best efficiently invest from here. Some of that means that they're looking for scalability, so price points can decline in that process on average as they look for volume play, like I need to kit a whole bunch of space. So we've seen that. We've seen parts of our market that are underperforming as a result of some of those shifts to perhaps more scalable volume types of categories. What the market was sort of waiting for is what we talked about in the last podcast, the kind of kick in of the experience economy to where audiences customers are back out, the consumers back out, they're traveling, and so those areas start to take on more and more investment. Some manufacturers, you could say on the display side, probably were thinking that was coming soon. And so really, as in response to demand, strong demand in early 22, started flooding the market with lots of product. So what we're hearing a lot about is core categories where growth we're actually more in a decline period from a revenue perspective because there was so much product that flowed into the market in 22. There's overhanging product actually in some parts of the channel, and price points came down as a result. So I think some of what we're hearing about is suppressed growth as a result of price point compression due to actual oversupply in some areas. In honesty, because some integrators were just waiting for product to fill out the project.
I'm glad you circled back on supply a little bit because we talked about it, but that really has been one of the big trends for 2023. We started a categorical question asking what's the top problem for your business for our monthly index. That was started in September 2022. It was about 45% saying supply. And that was an environment where these were really, really extreme. Like some companies were desperate to hire, but there was supply is even worse. Now, the most recent month, supply is at 16%. And these are less, I can just tell you from all the comments, these are just less urgent issues. It's not when we have the open ends, it's not, oh my God, I can't get, whatever. And when it's hiring, it's oh my God, I can't, they're hiring is still difficult, so I'll put that as the top issue, but it's not these blaring issues. So it's come down very clearly in the numbers, and we don't have a number that says rate severity 1 through 10, but I promise you, we have a lot of open-end data. I read all of it. I promise you that's also come down. And that's been a challenge. It's a little bit counterintuitive, but if you think about the way manufacturers serve the market, they'll take in a lot of market research, but they also just collect a ton of information in their just day-to-day business operations. They're having hundreds, thousands of conversations with end users about what exactly they need, and then they're selling or failing to sell based on price, technical specifications, usage details. And as they have all these conversations, that translates up through their corporate culture, their planning. It gets them to ask the right questions of the market researchers. It's really valuable information, and it keeps them closely in touch with the needs of the market. Now take where we are. 2020, outlier year. I mean, it was just crazy. What consumers wanted in 2020 is just not that relevant for 2023. 2021, still kind of a pandemic year, also started to have some pretty significant supply issues. 22 supply was so difficult that, okay, maybe demand patterns were coming back towards maybe a normal, like they're not super different from 2023. But the issue was that the conversations weren't all buy based on like specification, price, usage details. It was like, do you have product? Can I get it when I need it? So now we're in 2023 and supply issues are better. And all of a sudden it is all about those details again. And companies, through no fault of their own, are finding like, ooh, we shifted a little bit. Like, oh, it's away from us a little bit. Like, they don't know, like, in the past they would have said, hey, like, we have this good product, but folks don't understand what its purpose is. So like, we'll invest in some marketing, or we'll invest in some, content that explains it. Or like, folks are, among our suite of products, they really like, B and C and they don't like A. So we'll like focus more on B and C and support that better and design more products in that vein. And that just hasn't happened. I think that it's been a real challenge for not all companies, but just like the unlucky ones are finding like, dang. And I think it's a little bit displayed, a little bit projection, where it's like, oops, like through no fault of their own, like things were weird. It was just not able to, because of this pattern of years, pandemic and then supply chains, to figure out what exact needs and details of needs were going to be. And so that's been really tough, I think, in 2023.
Yeah, I think it's shifting patterns of demand for sure. It's what we're talking about of during the pandemic, there was a lot of investment in home. People were staying close to home. They were investing in better office space or productivity space for themselves. They were perhaps buying TVs at a greater rate. And so as that shifted out of home in a pronounced way, beginning in 22, certainly in 23, as people went to Taylor Swift concerts and other sorts of things that we've been talking about across these podcasts, that has been a pronounced shift in demand for sure. And so the parts of the market that are struggling more now and companies that are struggling more were perhaps still attached to some previous patterns of demand a little bit and are now kind of responding to or being affected by a shift to a different type of demand specification. In corporate space, I think one of the patterns that I'm seeing is a shift towards modularity, scalability. So the idea that in your office space, you can move equipment around, you can reconfigure it, you can plug and play, all those sorts of things. That can be a challenge to companies that are much more about integrated, high-end, certain specifications.
Custom.
Absolutely. So that is a challenge that our market will react to and adjust to over time.
Right.
But once again, it comes to this inflection point. So for 23, that we're kind of in this inflection point of we knew lower rates of growth, and we're seeing lots more variation of result across companies. Before, when you're in recovery, it was going to be pretty much all the rising tide lifts all boats. Whereas now, as that growth kind of settles and demand patterns change, we're hearing unevenness. So as we close out, what would be your take as we look at that 7.5%, let's call it, expected for 2023 growth, and then down a point, another point perhaps for next year, where you see us landing? Do you think we're on track for that? Do you think we're below, above? Where do you think we go?
Probably for 23 or a little challenge to hit that number. I'm just looking at the index where if you look at the year average, it's not out of the distribution as compared to the pre-pandemic years, but it would be lower than the, like, we have 2017, 2018, 2019 full years of data. It's just over 6 years of time series in there. So because we're a little lower than that, I think it's going to be hard for growth to kind of be above the norm for then, which was 6%-ish. So it's like, IOTA and the index are not like perfectly aligned, but it's like that's giving that signal to me that like this 7.5 that we're talking about roughly in IOTA is going to be a little difficult. Now that doesn't make me skeptical of like the long-term growth. I want to be really clear about that. I think, okay, this year is maybe a little bit more challenged because, emphasizing the one factor that was that return to in-person was maybe just a little weaker, a little bit more blown out in 2022 than we thought it was going to be, knowing that it was a 2022 phenomenon primarily, just not knowing how much there was left here in 2023. But I feel, even though maybe pessimistic about achieving that really strong number of growth for 2023, not pessimistic about the longer term numbers, because I see like the things that you're talking about, our industry adjusting, figuring things out as we get more normal. Companies in corporate figuring out what are good products. What are ones that we can sell that buyers are going to feel good about buying. In so many other spaces, in terms of just meeting the needs of what kind of digital signage needs do companies have, what content needs are associated with them. I think that these coming years we're going to see, with the resumption of normal sales processes, companies getting sharper, and that leading to strength in the long term. Not to say like throughout the IOTA numbers we're going up above it. I feel like, even though I feel maybe a little disappointed in what we've seen this year and like a little skeptical, can we hit that? We'll see. I don't feel that negativity for the more long term for those reasons. What
Yeah,
about you?
I share that. I think that it's easy to be long-term bullish, though I think part of what we're talking about, as we've always represented by IOTA, is the changing of the guard, the shifting landscape. So if I focus on 23 and I think about core traditional Pro AV technology, that is where I see more intrinsic challenge right now. And as I listen to the market feedback that we're getting, I look at the index. So integrators are busy. They're certainly doing work. They've recovered. But as in terms of a growth story, I would agree with you that 7.5 is optimistic especially in the Pro AV categories. The traditional, let's call it real traditional nuts and bolts types of product categories and opportunities. However, it's a bifurcated story, because where there is perhaps better growth and an offsetting is in non-traditional, more IT sounding. This could be AV over IP, could be distributed audio, could be back-end server technology to provide content in large installations like a Sphere. So that's a bit of an offset. Net, it's fair and reasonable to think that we probably trim off a little bit of growth from where we expected in 2023, but certainly long term. What we'll be challenged by as an industry and as a forecaster is how much do we represent in our numbers for Pro AV this new stuff, the new kind of opportunity for our marketplace. We always try to be sort of balanced in the way we add that in. But as I look at long-term numbers, I think that's where I'm also bullish as we kind of as Pro AV gets redefined into some of these new areas. So lots to be optimistic about. Certainly some caution as we look at this past result, but we're mostly looking forward at this point to kind of 23 and beyond, 24 and beyond. Thanks for joining us for this Xceptional Insights podcast. Join us next time as we look at the future and 24 and what plays out for that year and the years to come. Thanks so much.